Hey everybody, JS here, and I need to tell you about the biggest financial mistake I almost made in my entire life. So there I was, sitting in a real estate agent's office looking at this absolutely gorgeous $500,000 house on her tablet. Hardwood floors, granite countertops, one of those kitchens that looks like it belongs on a cooking show. And she slides this paper across the desk and says, "Your monthly payment would be $2,400, and according to your income, you're approved." And I swear, in that moment, I felt like I'd won the lottery. I was about to sign my name when my phone buzzed. It was my mom texting me a photo of my childhood dog who had just knocked over a plant. That dog cost my parents $3,000 in emergency vet bills once because he ate a sock. A sock! And something in my brain just clicked. If a dog eating a sock costs $3,000, what's a house gonna cost me? Spoiler alert, I didn't buy that house. And today I'm going to tell you exactly why, because the math behind home buying is so messed up that even the calculator is embarrassed. Let me start with a confession. I used to think I was pretty smart about money. I had a savings account, I knew what a 401k was, theoretically. I could tell you the difference between debit and credit, but when it came to understanding what I could actually afford for a house, I was as clueless as a goldfish trying to solve a Rubik's Cube. And the scary part? The actual experts, the banks and the lenders, they were encouraging my ignorance. They were basically handing me a shovel and saying, "Here, dig yourself into debt. We'll even help." So let's talk about this $500,000 house that everyone and their cousin is trying to buy right now. First question, where does everyone even get the down payment? Because last time I checked, $100,000 doesn't just fall out of the sky. That's 20% down, by the way. You need that to avoid paying something called PMI, which is basically insurance that protects the bank in case you can't pay the thing they're selling you. Let me repeat that. You pay extra money to protect the bank from you not being able to afford the thing they're selling you. If that doesn't sound backwards, I don't know what does. But okay, let's say you have that $100,000 sitting around. Maybe you saved it, maybe you sold a kidney on the black market, I'm not judging. You put that down, you finance $400,000, and the mortgage calculator, that beautiful lying machine, tells you your payment is $2,400 a month. And you think, hey, that's doable, I can swing that. Oh, buddy. Oh, friend. Oh, sweet, innocent person who still believes in fairy tales. That $2,400 is just the beginning of a financial adventure that makes Space Mountain look like a kiddie ride. Here's what the mortgage calculator doesn't tell you, and honestly should be illegal for them to hide. That $2,400 is just the mortgage, just the loan payment. But a house isn't like a car where you make payments and that's it. A house is like adopting a very expensive, very needy monster that constantly wants more money. Let me break this down like you're 5 years old, because apparently that's what the banks think we are. You've got your mortgage payment, that's $2,400. Then you've got property taxes. Depending on where you live, that could be $500 a month. Then homeowner's insurance, that's another $200. Then you need to set aside money for when stuff breaks, because stuff will break, I promise you. That's another $400 a month, if you're being smart about it. Add that up. Go ahead, I'll wait. That's $3,500 a month. That's $1,100 more than what the calculator told you it was. That's like ordering a burger and fries for $10 and then the waiter brings you a bill for $15 and you're like, where did the extra $5 come from? Except it's $1,000 extra dollars every single month for 30 years. Now, here's where it gets really fun. And by fun, I mean absolutely terrifying. To afford $3,500 a month in housing costs, you need to be making about $150,000 a year. And you're thinking, okay, I make around that, I'm good. But are you though? Are you really? Because after taxes, that $150,000 becomes about $100,000 take home. That's about $8,300 a month in your actual bank account. The house takes $3,500 of that immediately. You're left with $4,800 for literally everything else in your life. Let me paint you a picture of what that looks like. You've got your mortgage payment, let's say $400, insurance for the car, $150, gas and maintenance, $200, student loans because you went to college to get that good job that's now barely covering this house, $350, health insurance that your job doesn't fully cover, $180, groceries, and I'm talking normal groceries, not fancy organic stuff, $500, your utilities for that big, beautiful house, electricity, water, internet, all that, $300, phone bill, $75. You know what we're at now? We're at $2,155 in basic expenses, and you haven't had a single ounce of fun yet. You haven't bought new clothes, gone to a movie, had a beer with friends, bought a birthday present for anyone, nothing. And you still have $2,645 left, which sounds okay until you remember that financial experts say you should be saving 15% of your income for retirement. That's $1,875 a month. So now you're at $770 left over for the entire month for everything else. Want to go out to dinner? Better make it Taco Bell. Need new tires? Hope nothing else breaks. Want to take a vacation? Maybe in 5 years if you save every extra penny. This is what they call being house poor, and it's exactly as miserable as it sounds. Let me tell you a story. My friend Katie, smart girl, works in tech, makes about $140,000 a year. She bought a $480,000 house 3 years ago because her bank said she qualified, and her parents kept asking when she was going to settle down and buy property. You know what Katie told me last month? She said, "JS, I can't remember the last time I wasn't stressed about money. I make 6 figures and I feel broke all the time." Katie's water heater died last year. That was $1,800. Then her fence got destroyed in a storm. That was $4,500. Then her AC unit started making this horrible grinding noise, and the repair guy said it was on its last legs. That's going to be $6,000 to replace. And Katie doesn't have that money just sitting around because every month all her money goes to the house and the basic costs of being alive. This is the reality nobody talks about. Everyone posts photos of their beautiful new home on Instagram. Nobody posts photos of their credit card statement or their empty savings account or themselves crying while looking at a broken appliance. And here's the really messed up part. In the first few years of your mortgage, most of your payment is going to interest, not to actually owning the house. Let me explain this because it made me irrationally angry when I learned it. On a $400,000 loan at 7% interest, in the first year, you're paying about $28,000 in interest and only $6,000 towards the actual principal. That means out of your $2,400 monthly payment, about $2,000 is just going to the bank. It's disappearing. It's almost like rent, except you also have to pay for everything that breaks. People love to say renting is throwing money away, but let me tell you, paying $28,000 a year in interest is also throwing money away, except you're also on the hook for the roof and the plumbing and the foundation and everything else. Now, I know what you're thinking, but JS, what about building equity? What about investing in my future? And okay, yes, you do build equity over time, very slowly, painfully slowly, but you know what else builds wealth? Investing the difference between renting and buying in an index fund. Let's say you rent for $2,000 a month instead of buying that $500,000 house where your total costs are $3,500. That's $1,500 a month you could invest. Over 30 years with average market returns of about 10%, you'd have over $3 million. That's not a typo, $3 million. Meanwhile, if you bought the house, after 30 years, you'd own a house that's maybe $800,000 if you're lucky, but you would have paid over $550,000 in interest to get there. I'm not saying don't ever buy a house. I'm saying do the actual math first. Real math, not bank math. Here's my rule, and this is the rule that saved my financial life. Your housing costs, all of them combined, should be no more than 25% of your take-home pay. Not your gross salary, your take-home, the actual money that hits your bank account. So if you're taking home $8,300 a month, you should spend no more than about $2,075 on housing. Total, everything included. And I know what you're thinking, but I can't get a nice house for that. Exactly, that's my point. The $500,000 house is too expensive. It's not you failing at math, it's the market being completely insane. Your options are buy a cheaper house, save a bigger down payment, increase your income, move somewhere more affordable, or keep renting. And I know option 5 makes people uncomfortable, but renting is not losing. Renting is not failure. Renting while you build wealth in other ways is actually really smart. I eventually bought a house. You want to know what I bought? A
a $260,000 fixer-upper that needed work. My friends thought I was crazy. You can afford better, they said. Why are you settling, they asked. And you know what? That decision is why I sleep well at night. My total housing costs are about $2,000 a month. That's less than half what they'd be on that $500,000 house. What does that mean for my life? It means I maxed out my retirement contributions last year. It means I have 6 months of expenses saved. It means when my transmission died, it was annoying, but it didn't destroy me. It means I'm not house poor. I'm just a regular person with a house who can also have a life. Here's something wild that nobody tells you. When interest rates were 3% a few years ago, a $400,000 mortgage cost about $1,700. Now, at 7%, that same loan is $2,400. That's $700 more every single month, $8,400 more every year, just because of when you happen to buy.
30 years, that's an extra $252,000 going to the bank. That's an entire house worth of money in interest. And people are still buying at these rates because they're convinced they have to buy now or be priced out forever. But markets change, rates change, prices adjust. The only thing that's permanent is if you destroy your finances trying to keep up. Let me tell you about my buddy Marcus. Marcus makes $175,000 a year. He could easily qualify for a $600,000 house. But Marcus is renting a nice apartment for $2,200 a month and investing the difference. In about 8 years, Marcus is going to buy a house in cash. No mortgage, no interest, no stress. Just straight up ownership. Is that the right path for everyone? No. But Marcus made a conscious choice based on math, not based on what society told him he should do. Here's a question I want you to ask yourself, and be really honest. Why do you want to buy a house? Is it because you genuinely want to own property with all the responsibilities that come with it? Or is it because your parents keep asking when you're going to buy, because your friends are buying, because social media makes you feel behind? Those are terrible reasons to make a $500,000 decision. I met a guy last year. He's 35, makes good money, owns a $560,000 house, and this guy was miserable. He told me he has credit card debt because emergencies keep happening. He hasn't contributed to retirement in 2 years. He drives a car that's falling apart. He can't afford to vacation. And his house isn't even that nice. He bought it because his lender said he qualified, and he felt pressure to buy before prices went higher. Now he's stuck. Can't sell without losing money, can't afford to stay comfortably, just trapped in this awful middle zone of looking successful while actually struggling. Don't be that guy, please, I'm begging you. Here's the truth that the real estate industry doesn't want you to know. The mortgage calculator is lying. The bank is not your friend. They make money when you borrow more. Your real estate agent makes more commission on expensive houses. Nobody in this transaction is looking out for your long-term financial health except you. So, do the real math. Be brutally honest with yourself. Make a realistic budget, not a hopeful one. Include everything. Then look at what's left after the housing costs and ask yourself, can I live on this? Will this make me happy or stressed? If the answer is stressed, the house is too expensive. Keep looking. Buy smaller. Wait longer. And if people judge you for it, remember they don't see your bank account or your stress levels. They only see the surface. You know what's actually impressive? Having money saved for retirement, being able to handle emergencies, being able to help people you love when they need it, being able to take a new job opportunity without worrying about the mortgage. That's impressive. A house that's slowly bankrupting you? That's just sad. Look, I get it. The housing market is frustrating. It feels unfair. Previous generations had it easier in many ways. But you know what doesn't help? Ruining your life to prove a point. The market doesn't care about your frustration. The only thing that matters is whether you can actually, truly afford what you're buying. So, here's my final piece of advice. Before you buy any house, create a real budget. Include every single expense, then subtract housing costs and see what's left. If what's left makes you anxious, the house is too expensive, period.
Choose financial peace over impressing people. Choose actual affordability over what the bank says. Choose a life where money serves you instead of crushing you. The $500,000 house will still exist next year. Maybe you'll be ready then. Maybe the market will shift. Maybe you'll realize you never wanted it. But if you buy before you're ready, you will regret it every month when that payment is due and there's nothing left. All right, I've yelled at you enough. Do the math, be honest, don't let anyone pressure you into financial misery. You deserve better than being house poor. You deserve peace of mind. This is JS reminding you that the best financial decision is the one that lets you sleep at night. Now go forth and make good choices. See you next time.